Hi there, welcome to Kneppy Invests. Are you ready for a smorgasbord of companies? In this video, I'm going to be featuring 8 companies that achieved an operational cash flow positive June quarter. And the reason I'm going to be featuring 8 companies in this one video is because 2 companies, XREF and Selfwealth, have decided to release their September quarter Appendix 4C today on October the 6th. And before I feature those 2 companies in a video, standalone videos, I want to finish my mission on covering every single company that achieved an operational cash flow positive June quarter. And to achieve that mission, I have to cover 9 companies. 8 companies in this video, and then 1 standalone video on Threat Protect, which I will release tomorrow morning on the 7th of October. So look out for that video. And once I finish that video, I can now or then focus on companies that have released their Appendix 4C or 5B for the September quarter. And the first video I'll be doing in that video series will be on XREF. So look out for that video, which I more than likely will release on the afternoon or evening on the 7th of October. And then I'll do a video on Selfwealth. More than likely, I'll release that video on the weekend. The 8 companies I'll be looking at in this video, the vast majority of these companies are not investable. So hopefully I'll be able to get through these companies fairly quickly. The first company we'll be looking at this video is ViaGold Rare Earth, ticker code VIA. This company is a little bit more diversified than just in the rare earth space, but their major segment is rare earth refinery and separation. They also have a leasing and capital financing segment and investment holdings segment. They listed on the ASX in 1996, and currently the market cap is 41 million. That's at a share price of 49 cents. Now, a few months ago, the share price was like 5 cents. So this has been on almost a 10-bagger in a few months' time. And it's been a significant increase in interest around this company for some reason, maybe because they've decided to really focus on rare earths. And that segment, that sector, maybe is exciting to some people. Revenue for the financial year 21, 19.2 million. They were operational cash flow positive by 4.8 million, and they finished the quarter with $0.6 million of cash. The reason why cash fell, even though they're operating cash flow positive, was because they did make a fair few investments totaling $4 million. They also lent money to others, $5.8 million. Now, this company is China-based, and I am very wary about companies that are based in China, particularly when they are making loans to others, because sometimes we have seen in the past when Chinese companies make loans to others, that money just disappears and it never comes back to the company. I'm not going to show you the financial history or the chart for ViaGold because they both look very ugly. Instead, what I've shown you here is the trading history of ViaGold ever since the start of this year. And in January, February, and March, the shares in this company were only traded on 6 days. But during those 6 days, the share price actually increased from 3.5 cents to 8.2 cents. So more than doubled on 6 days of trading, but very low volume. And then in April, May, June and July, there was not one single share traded in ViaGold. So the share price did nothing. You would have been horrified if you're owner of this company's shares. But something happened towards the end of August. All of a sudden, the market got interested in this company. Initially, that interest was to drive the share price down. So the share price fell from that 8.2 cents all the way back to 4.2 cents. And in consecutive days, we saw the share price fall 6%, 7%, 28%, and then 14%. So a little bit more action in this company's trading. But then for some reason, the interest in this company went from we need to sell shares to we need to buy ViaGold shares. And then we saw the share price rise on the 6th of September, 26%. And then on the 8th of September, the share price rose 126% from 5.3 cents to 12 cents. And the share price has kept on rising ever since the 8th of September. So in 1 month, the share price has risen from 12 cents to a current share price of 49 cents. The other thing to take away from that rise in share price, it's been a quadruple rise in share price in 1 month, has been the lack of volume. So very low volume. There's just no one selling. And if there's no one selling and there is someone who wants to buy in, the only way they can get the allotment of shares they want is to drive the share price higher. The one concern here is because we're seeing this rapid increase in share price on low volume, it won't take much to drive the share price down. So there might be some profit takers who will come in, see the share price quadruple in a month and want to lock in their shares. But because these shares in this company are illiquidly traded, it won't take much to set the share price down again. So you have to be careful when a company's shares are illiquidly traded because there's a lot of volatility. And ViaGold is a classic example of what happens or what can happen when a company's shares are illiquidly traded. Next company is GWR. This is an iron ore producer. Now, the problem is with a company like this, a very small iron ore producer, is typically the cost these companies have for getting the iron ore out of the ground is going to be significantly higher than those larger companies like Fortescue and Rio Tinto. And when the iron ore prices come back, they are going to be largely affected by that, more affected than those large companies. But because the iron ore prices were high for a period of time, and this was an iron ore producer, this company was producing a fair bit of cash. And if you compare the cash this company produced in the June quarter, which was 15.5 million of operational cash flow, and compare that to the market, which at 14 cents was 38 million, you can see if the iron ore prices start going up again, this company would be very attractive. They received $83 million of receipts in financial year 21 and were operational cash flow positive by almost $20 million for the financial year. They also finished the quarter or the year with $24 million of cash. Now, there is one problem though moving forward for GWR, and that is the iron ore prices. And the reason it is a problem is because they have suspended operations. So on the 19th of September, GWR halted mining operations at the C4 iron mine for 30 days, whilst it monitors the iron ore price and considers a position in regard to recommencing operations. And the main reason is the C1 unaudited cost for getting the iron ore out of the ground was $120 per wet metric ton, which was higher than what the iron ore price is. So to get the iron ore out of the ground cost more than what they could sell it for. And that's exactly why they suspended mining operations for the time being. A company like GWR's share price is going to be highly influenced by the iron ore prices, and we can definitely see that when we look at the weekly chart. In fact, a lot of interest in GWR from September last year when the share price was about 6 cents to around about the start of this year when the share price reached 45 or 46 cents. And then ever since the iron ore prices started coming down, we've seen the share price in GWR absolutely fall off a cliff. In fact, it's fallen from the 40 cents range to a current share price of 13 cents. So you can see here that GWR's performance in regards to not only the share price, but also their financial performance is highly correlated or dependent on iron ore prices. Next company I want to look at is Korab Resources Limited. I don't want to spend too much time on this company. Just look at the June quarter report. $160,000 in receipts. They spent $45,000 in administration and corporate costs and were operational cash flow positive by $115,000. This is a mining exploration company listed on the ASX 2005. Market cap of $7 million at 2 cents. Not a lot of cash, only $93,000 of cash. And they repaid $54,000 of loans. They do have a few projects, a magnesium carbonate and a rock phosphate project in NT. They also have gold, silver, copper, cobalt, nickel, and polymetallic projects in Australia and overseas. And the main source of revenue right now isn't any operations, isn't any production, it's just tenement subleasing fees. As we turn our attention to Korab's weekly chart going back 5 years, nothing at all exciting here. Our share price really going sideways. You could maybe argue the share price has moved in to a potential uptrend over the past few months. At this point in time, I'd say it's only potential, just because over the past 5 years, really the share price has done nothing, and financial-wise, there's nothing to get excited about this company. The only reason you might take a position in Korab is if you have a lot of faith in management. The next company I want to look at is potentially the most exciting company in terms of what they're doing, and that is Volt Power, ticker code VPR. This company is a power generation infrastructure asset equipment developer and owner. They do have something in the advanced stage of initial commercialization, which is a zero emission waste heat to electricity generation equipment solution. Listed on the ASX in 1991, so it's been around for a while, but the market cap is 28 million at 0.3 cents, and that's one of the dead giveaways why I have no interest in taking a position in this company. Cash receipts for the financial year 21, 857,000, and they were operational cash flow negative, and only $767,000 of cash at the end of the financial year. Now let's have a look at two reasons why I have no interest in Volt Power. And the first reason is no discernible uptrend in receipts over the past 3.5 years. Receipts just going sideways, end of story. And the second reason I have no interest in Volt Power is simply around what the share price is doing and has been doing over the past 4 years. This is the weekly chart for the company going back to 2017, and the shares in this company have been trading between 0.1 cents and 0.4 cents over those 4 years. Nothing to get excited with. In fact, I don't like buying into companies with a share price this low. The next 4 companies I'll be looking at include a market darling. If we go back 5 years ago, that's Yowie Group, a company called Health Plant Protein, which did change the name recently and is all about macadamias. So that's actually one of the most interesting companies I've looked at in this video. Another company called CAQ Holdings and Victor Group Enterprise Management. I have zero interest in both of those companies, both Chinese based, and one of these companies' shares has only been traded twice in 3 years. First company, this next batch of 4 is CAQ Holdings, and I have zero interest in this company. They are Chinese based, and that's one of the reasons. They have a lease on investment property in China. It seems like only one investment property. They also dabble in jewelry trading, but they've been listed on the ASX for 16 years and they have not been successful. We know they have not been successful because the market cap right now at 1.5 cents is $11 million. Not much receipts from customers, not much operational cash flow, only $50,000 in a half year, not much cash on hand. So nothing to get excited about this company, just looking at the financial state. And there are 2 more reasons why we should not be excited about this company. And one of those reasons we shouldn't have any interest in buying into CAQ is simply their receipts history. There's no discernible growth here, end of story. And even uglier than the receipts history for CAQ is the share price over the past 7 years. This is the weekly chart over a 10-year period for CAQ. And the share price high for this company was way back in 2014 when the share price got to about 26 cents. And ever since that high of 26 cents in 2014, the share price has been dropping and the current share price is 1.6 cents. No reason at all to buy in this company right now, just based off the cash receipts history and off the chart. Next company is Victor Group, and I sometimes do get excited about software companies, which Victor Group is. Victor Group listed on the ASX in May 2014, market cap of $17 million at 3 cents, and receipts to customers for financial year 21, $12.5 million. And they were operational cash flow positive by $4.5 million. Now, that sort of cash receipts and operational cash flow for a company with a market cap of 17 million is attractive. So why do I have no interest in taking a position in this company? Well, it's twofold. The first reason is when we look at the cash receipts history, but the main reason is when we look at the chart. And this company might be the most illiquidly traded company I have ever seen. The first significant problem with Victor Group is the lumpiness to receipts. We can see massive spikes in receipts, including one quarter of the December quarter 2019, where receipts went up to 10.6 million. Unfortunately, the next 2 quarters, receipts went down to 0. So this is a major problem for this company. I would like to see little less lumpiness a bit more of a smoothness in receipts. And if you did smooth out receipts, I don't think you would find receipts growing through time. And that's also a problem when it comes to a software company. I like to see receipts growing at a really good clip. Though I do have a problem with the cash receipts history for Victor Group, there is another major problem I have with this company, and it's all about the lack of trading in the company's shares. And what I've done with the chart is I've represented the end of a calendar year by a vertical blue line. So the first vertical blue line here is the end of 2014. That's the year this company listed on the ASX. The next vertical blue line is the end of 2015, and the next one is the end of 2016. And you'll notice the distance between each vertical blue line is shortening, and that means there's less and less shares traded in this company in each successive year. But it comes even worse. You'll notice that there's a jump from 2018 to 2021, and that means there was a significant period of time, over a 1 year period of time, in fact it could be even 2 years period of time, where there was not one single share traded in this company. In fact, over the past 3 years, shares in this company have only been traded on 2 days, and that was March this year and maybe another day in 2019. And that is a significant problem, because if you take a position in Victor Group and you need to sell out for some reason, you might not have the opportunity to sell out because no one is willing to buy. And that is a major issue and the major reason why you would never even think about taking a position in Victor Group. Now on to Yowie Group, and I've definitely heard about this company. In fact, not only have I heard about this company, I've even seen their products in some stores. This is a confectionery company. They produce those Yowie chocolates. So go into Woolworths, Coles, maybe you'll see some of those Yowie chocolates hanging around. I haven't seen one for a while, so maybe they've stopped selling them. I don't know. Anyway, Yowie listed on the ASX in 1999. Current market cap $9.6 million at 4.4 cents. Yowie Group was a market darling for a while, about 5 years ago. You'd be able to see that when we look at the chart. Cash receipts for financial year 21, 11.3 million. Operating cash flow positive 2.4 million. Fair bit of cash on hand, 8.4 million, which means the enterprise value is 1.2 million. That's fairly low for a company that did generate $2.4 million of cash in a financial year. When we look at the receipts history for Yarrow Group, going back to the June quarter 2014, initially things were looking really exciting for this company, particularly during 2016 and into the start of 2017. In fact, receipts grew from $220,000 in the December quarter 2014 to a top of $6 million in the March quarter 2017. Unfortunately, seems like Yowie chocolates weren't a massive hit, and we've seen receipts fall away ever since that March quarter 2017, and currently only $3.7 million in receipts. So it's not exactly what you want to see for a company that you have taken a position in. Instead of receipts growing, receipts have been falling over the past 4 years. Yowie Group was a bit of a market darling back in 2014 through to about 2016. Share price rose from about 15 to 20 cents to a top of $1.30 in the middle of 2015. Unfortunately, business did not really grow. People weren't that excited about Yowie chocolates, and the share price fell off a cliff during 2016 and 2017, falling from $1 to about 5 cents during 2020, and the share price hasn't really recovered since then. So nothing to get too excited about Yowie. Now the only thing to get excited about is maybe the enterprise value is a little bit low for this sort of company. So 1.5 million or whatever it was does seem to be a little bit low. So maybe there could be some value here, particularly if receipts go sideways. Maybe there is some sort of market out there for Yowie chocolates. The final company I want to talk about is a company I thought was a recent IPO, and that's Health Plan and Protein. But as I dug a little bit deeper, this is not a recent IPO. They just changed their name from Butterum to Health Plan and Protein and have a new ticker code, and that is HPP. The The reason they changed the name is because they sold out of their ginger and tourism businesses and now focusing on macadamias, which leads me to compare this company to Select Harvest. Now, Select Harvest is a very successful almond grower, producer, whatnot. And if Health Plant and Protein can be successful in their macadamia business, maybe there is a future for this company. They listed in 1989, so this company in all their forms have been around for about 30 years. Current market cap, only $23 million. That's at a share price of 19 cents. They do produce a fair bit of receipts, so almost $9 million of receipts in the June quarter. But even though they did produce a fair bit of, that's a fair bit of receipts, they were only operational cash flow positive, $560,000. So not a lot to get excited when you look at their financial results for the June quarter and the financial year 21. $43 million receipts for the financial year, but they were operational cash flow negative by $3.4 million. If we look at the receipts history for Health, Plant and Protein over the past 6 quarters, things have gone backwards, falling from $19.8 million in the June quarter 2020 to $9 million in the June quarter 2021. Maybe the reason behind that is because they sold out of their ginger and tourism businesses and now are focusing solely on macadamias. Maybe we need a bit more confirmation. That's the reason why receipts have fallen. An ugly looking chart for Health, Plant and Protein. This is going back to 2013. Between 2013 and 2016, share price was around about 60 to 70 cents. But since then, the share price has fallen to a current share price of 17.5 cents. So nothing to get real excited about Health, Plant and Protein just yet when we look at their financials, when we look at the chart. Maybe the only reason you might get excited about this company is because they are creating macadamias. That's all I have for this final Group June Quarterly Report video. Hope you've enjoyed it. Hope you've learned something about these 8 companies on the ASX. If you are a holder in any of these companies, I'd love to hear your opinion on why you are holding or have a shareholding in these companies. So leave it in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.